Good morning. In this lecture, we are going to discuss monetary policy, tools and techniques. Before this, there is a need to explain what is monetary policy. Monetary policy is the macroeconomic policy laid down by the Central Bank of India. It involves management of money supply and interest rate and is the demand side economic policy used by the government of a country to achieve macroeconomic objectives like inflation, consumption, growth and liquidity. So now we will explain goals of monetary policy. Goals of monetary policy: number 1, high employment, economic growth, price stability, interest rate stability, financial market stability, foreign exchange market stability. High employment. High employment is the goal of each and every country. Every country wants to achieve the goal of high employment because under unemployment, or if the number of the people they are unemployed in any country, so that is a burden on the nation and that affects the economic growth of a country. So when unemployment is high, the economy has not only idle workers but also idle resources, because if the people they are not employed and if the degree of unemployment is very high, it seems investment is still not taking place, and if investment is not taking place, then resources of country are not properly utilized. But now the question arises how unemployment should be reduced, what the role of monetary policy, how does monetary policy works to reduce unemployment. Because there are number of kinds of unemployment problems which we are facing in our country. There is a seasonal unemployment, frictional unemployment, educated unemployment, and there are so on different kinds of unemployment that is prevailing in the economy. The monetary policy provides such a facility to the investors, or the central bank by liberalizing the monetary policy provides the opportunities of credit to the investor, and if the more and more opportunities of the credit will be available to the investor, so the investor they will be easily access these resources and these resources can be further diverted into investment, and when the more and more investment is taking place, so the more and more opportunities of the employment will be available in the economy, and when the more employment opportunities will be available in the economy, so it will be directly hitting the unemployment and the rate of unemployment that will be decreased. Now the second, which we were talking about, the economic growth. The goal of steady economic growth. If you define economic growth is a sustained increase in per capita income. Economic growth provides the goods and services to the people. If the speed of the economic growth will be lower, then the people they will not be able to get the number of the goods and services which is requires for the to earn their livelihood. So when there is the goal of economic growth, if it is high and if it increasing the pace of the economy, then the policies can be specifically enhanced or to be made so that more and more economic growth can be taken place. industrial policy that can be liberalized. More and more opportunities to the investors, specifically for the private sector, just like the government is doing the startup and the small scale industries, subsidies, rebates that can be given, and that will be for these supply of economic policy, so that will certainly increase the economic growth of the economy, and this is the biggest goal of monetary policy. And if the economic growth is continuously the sustained increasing in the economy, so that the other sectors of the economy, they can be benefited with the economic growth which is taking place in the economy. The third, which we are going to discuss about, the price stability. Price stability, because in the recent years the policymakers, they are very much aware about it. They are putting the emphasis on the how the prices can be stable, because if the prices will be stable, the stability of the price, that will both the consumers and the producers, they will be benefit. The consumers, they will not have the stock, they can be able to buy the number of the goods and services in the prevailing income level which they are having. There will be no much trade cycles, and the investor, they will not have any fear in their mind that when the fluctuations of the trade cycles that is taking place, so they will have any doubts or any fear in their minds how if the prices will be decreasing in the future, so how they will retain their cost of production which is in that. So extreme inflation or the continued increase in the inflation, so that will strain the social fabric, that will affect the social development of a country, and that will also affect the investment in the economy also. And you can see the examples of in Argentina, Brazil, Russia in the recent past. Now the next goal of the monetary policy is interest rate stability. Interest rate stability explains there should be no much fluctuations in the interest rate, because the interest rate is affecting both the consumers as well as to the producers, and central bank may also reduce the upward movements that is taking place in the interest rate, because such movements will be affecting the general hostility towards the central banks and leads to demand that their interdependence of power should be reduced. So what I want to convey to you here, that if the interest rate continuously will be fluctuating, because this is one of the goal of the monetary policy, if continuously it is fluctuating, then the consumers who are there buying any asset, just like you can say that investing in the real estate or buying the goods and services from the market, so what will be happening, they have taken the loan from the banks, and their installment that will be high, EMI which we are using word. So when their installment will be high, so that will be directly affecting on their level of living. On the other side also, when the interest rate will be fluctuating, so the investors, they will not be in a capacity to invest more money, and if they will be not in a capacity to invest the more money, so they will be having the impact on the not only the one sector of the economy, but the many other sectors of the economy, because every sector is an interdependent sector, and the one sector is depending on the other sector of the economy. The next we are going to discuss about the stability of the financial markets, because the financial markets that channel the funds from the spending units to the deficit spending units, thereby leading to a sharp contraction in the economic policy. So the promotion of the more stable system in which the financial crises are avoided is there an important goal of a central bank, or you can say about a monetary policy. So the stability of the financial market is also fostered by interest stability, because fluctuations in interest creates uncertainty for the financial firms, affecting both their profits as well as their net worth also. So there is need to, the financial stability must be there, because if there is no financial stability, so that will affect the financial firms, there is uncertainty in that, and there will be no in a position for the further advancing the loans to the from the one channel to the another channel. The next we are going to discuss about the stability in the foreign exchange markets, because the value of dollar is, that becomes the major consideration for the bank of every bank of a country. Just we can take example of the Canada. The Canadian industry is less competitive with those abroad, and decrease in the exchange rate stimulates inflation in Canada. So just like that, Canada, the India is also faces sometimes such problems regarding. So there is a need for the stability in foreign exchange markets, and the stability, extreme movements in the exchange markets and the foreign exchange markets is thus viewed as a worthy goal of the monetary policy. In fact, an country which are even more dependent on foreign trade, stability in foreign exchange markets takes on average great importance. So this is also one of the biggest goal of the central bank, or you can say that monetary policy. So how the exchange rate, because our exports, imports, that is depending on that. When exchange rate that will be increasing, so what will be happening? So your export will be affected, your imports that will of that country will also be affected. If we are looking upon all these goals which we have recently explained, so there are some conflicts among the goals also. So the many goals, they are mentioned as consistent with each other. For example, high employment with economic growth, whether both are interlinked with whether economic growth is taking place, high employment can be achieved or not. Such are the questions that is the question can be asked. Stability with the financial market stability. So if the interest stability is there, so whether that interest stability is with the financial market stability. If the price stability is also there, so whether that can be the stability with the interest rates also, whether the interest rate is increasing, decreasing, it is having the impact on inflation. So such type of the questions I am leaving to you, so you can ask and think on that. And the conflict among the goals may thus present central banks with some hard choices, because when one of the other goal, if they are going to be affected, then the central bank, so they are taking some hard decisions, so that the growth of the economy, the economic growth of the economy, that will not be affected. Now we are going to discuss about the conventional monetary policy tools. During the normal times, the Federal Reserve uses three tools of the monetary policy. One is the open market operations, second one is the discount lending, and third one is the reserve requirements, that is controlling the money supply, interest rates, and these are referred to as a conventional monetary policy tools. So these are the non-conventional monetary policy tools during the global financial crisis we faced in the 2008, when the global crisis that took place. In that, there is a liquidity provision. The Federal Reserves implemented unprecedented increase in its lending policies to provide liquidity to the financial markets. One is a discount window expansion, second is the term auction facility, and the third one is the new lending programs. So if we do talk about the conventional monetary policy, the open market operations, so that is affecting the quantity of the reserves and the monetary base, and that also changes in borrowers research affect the monetary base, and that also changes in the reserve requirements affect the monetary multiplier also. And the federal funds rates the interest rate on overnight loans of the reserves from one bank to another. So that these are the primary indicators of the stance of the monetary policy. Now we are coming to the open market operations. Open market operations, that is working on that. One is a dynamic, second one is a defensive. Dynamic mean to change in the market operations. Then second one, defensive, mean to offset other factors affecting the market operations, typically uses the reports. What are the advantages of open market operations? Fed These federal has complete control, flexible and the precise, easily reversed and the implemented quickly. So the discount loans, there are the three types of the discount loans which we are talking: primary credit, secondary credit, seasonal credit, and the lenders last resort functions to private banks. So there is no need to be panic. For examples, we can talk about the contentious illusions to prevent the non-bank financial panics. For examples, 1987 stock market crash in the September 11 the terrorist incident. So the discount policy advantages lenders of the last resort role. What are the disadvantages? Confusion interpreting discount rate changes. Fluctuations in discount loans cause unintended fluctuations in money supply, not fully controlled by the federal system. So what are the reserve requirements? The powerful, what are the reserve requirements? The powerful effect. What are the disadvantages? Small changes have very large effect on monetary policy. Raising cause liquidity and problems for banks. Frequent changes cause uncertainty for banks and the tax on banks also. So if you are looking upon the demand and supply in the market reserves, because what is the significance of the monetary policy in today's context? If you see in the 1930s, the recession that was taken place, and the people, they were not initiated to make the investment in the economy. So the Reserve Bank, that there was that time it was realized that the monetary policy must be there, so that can enhance, that can give the confidence in the minds of the investors, so they can be in a position to make the investment in the economy. So there is a such type of the requirement that was needed at that time. So there is a significance of the monetary policy is very, very important, because if the monetary policy will not be there, so because because of the deflation, sometime because of trade cycles, the investor, they are losing their faith in the system, and they are not coming forward to make the investment in the economy, and specifically the basic purpose or the aim of the monetary policy. So how the situation that can be improved if monetary policy does not work, if the monetary policy does not take the things in such a way so that can enhance the economic growth of the economy, and to build up the confidence in the minds of the investors. So when such conventional monetary policy, when there is a failure, so what the problem that arises at that time? Because your financial system that will be seized, your economy, there are full-scale financial crisis must be there, that can be there, and there is a negative shock in the economy that may be there. So when the monetary policy fails, if you are talking about the conventional monetary policy, when it fails, so such type of situation that can be arises, deflation continuously can be emerged, there is a financial crisis that can be emerged, and there is a such type of the negative shocks, you can say, that the trade cycle that can be taken place. So after 1990 economic reforms, you will see that the monetary policy is reviewed after every 3 months, so that we can see that what is the need of whether the interest rate must be decreased, not decrease, or there is a need to decrease, whether there is a need to increase your cash reserve ratio, your statutory liquidity ratio, your repo rate, reverse repo rate. So such type of the system that is prevailing, because we are a fastest growing economy at the world level, at the international market, the different the system, because if there is a crisis in the one nation, that crisis will be affecting to the other nation because of the open economy. So the significance or the importance of the monetary policy that becomes very, very important regarding the control of the system in the financial system in the economy. Thank you so much. We will another part we will discuss in the other lecture.